Canadian natural resources surged 32% year to date, not because oil prices rose in a straight line, but because the map of global energy supply just tore in half. Iran's attack on Kuwait International Airport last week, killing at least one person and damaging Terminal 1, was not a stray escalation. It was the moment markets priced that the Strait of Hormuz, through which 25% of global seaborne oil transits, may not return to normal within any planning horizon that institutional energy portfolios can absorb. Brent crude swung from US $90 to $106 in a single week, not on inventory data, but on each successive shipping update from the Gulf. Kuwait Petroleum's own managing director told the S&P Global Energy Conference that even after Hormuz reopens, if it reopens, Kuwait would need 6 to 8 weeks to restore 70% of normal production, with the remaining 30% requiring another month. Maersk's CEO said supply chain and freight routing changes are already structural. Reopening the strait would not immediately normalize cargo flows. The market is not pricing a ceasefire resolution. It is pricing a new routing regime. That is the positioning shift that explains why Canadian natural resources and Suncor Energy have drawn sustained institutional buying, rather than the speculative spike typical of geopolitical oil spikes. Canada's LNG exports travel the western North Pacific route, entirely outside the Hormuz choke point. TC Energy's Coastal GasLink pipeline feeds LNG Canada, and the government is accelerating capacity expansion. Institutional energy desks that built positions on Middle East supply assumptions are rotating the supply security premium into non-Gulf producers, and the price action in Canadian oil sands names reflects that reallocation, not just a commodity beta trade. The question the rally leaves open is whether this premium survives Trump's renewed pressure to broker a ceasefire. The CFTC is already investigating $800 million in suspicious oil trades placed before a Trump social media post. That political volatility introduces a repricing risk that the structural supply chain argument alone cannot contain. The TSX fell more than 150 points on Wednesday, even as Canadian energy names held or gained. And that divergence is the mechanism the opening chapter's supply chain thesis does not fully explain. The sell-off was not indiscriminate, it was yield-driven. The 10-year Treasury yield climbed to 4.43% from 4.39%, still modest in isolation, but it has risen 46 basis points since the Iran war began, when it sat at 3.97%. That cumulative move is repricing the discount rate on every non-commodity TSX holding simultaneously. The transmission path is direct. Higher oil prices feed inflation expectations. Inflation expectations push bond yields. Higher yields compress the present value of future earnings in rate-sensitive sectors, financials, utilities, REITs, and the broader industrial base. Retail and foreign net flows that had been accumulating Canadian equities on the record-high momentum narrative reversed into selling on Wednesday, while institutional buying remained concentrated in energy names. The result was a two-speed domestic market. Energy re-rates upward on structural supply realignment, while the rest of the TSX corrects on the same oil price that made energy attractive. Suncor's break-even cost reduction to US $43 per barrel, down from US $53, with a further $5 target by 2028, is the number that explains why institutional energy positioning did not flinch at the broader TSX decline. At WTI above US $90, Suncor generates free cash flow that insulates the position, even if yields continue climbing. The energy sector is not immune to rate pressure, but its earnings uplift from current oil prices exceeds the discount rate drag by a margin that other TSX sectors cannot match at this yield level. What the yield move does not settle is whether the Bank of Canada will respond with rate guidance before the next TSX inflection. Canadian Services PMI edged up to an 18-month high in the latest print, with operating costs accelerating, a domestic inflation signal that complicates any dovish pivot. If the Bank of Canada signals tighter for longer, the TSX's non-energy sectors face a second compression wave that the energy rally cannot offset at the index level. Broadcom stock fell 12% after hours, despite reporting AI semiconductor revenue up 143% year over year to US $10.8 billion. And that price reaction is the data point that tests whether the capital rotating into Canadian commodities is a durable regime shift or a temporary safe haven move. The headline to reaction gap is precise. Q3 AI chip guidance of $16 billion came in below the $17.2 billion analyst consensus, and investors who had accumulated the stock into record highs, adding roughly $300 billion in market value over 5 sessions, unwound positioning on the miss. CEO Hock Tan disclosed that Broadcom's bookings backlog reached $30 billion in the quarter, with visibility extending to 2028 and AI chip revenue guidance exceeding $100 billion for fiscal 2027. That is not a weak business. The sell-off was a positioning event, not a fundamental deterioration. Leveraged longs that built into earnings at record valuations, 42 times forward earnings, needed a catalyst to exit, and a guidance number below consensus provided it. Retail flows that had been chasing the AI chip rally encountered institutional selling as the print crossed the tape. The connection back to Canadian equities is structural. The capital that rotated out of Broadcom and the broader AI chip trade on Wednesday did not disappear. It moved into defensive and commodity exposures. The TSX energy sector, already elevated on Hormuz supply premium, absorbed part of that flow, as institutional desks rebalanced from growth to real asset allocation. Canadian natural resources, Suncor, and TC Energy sit at the intersection of both the geopolitical supply re-rating and the growth to commodity rotation, two distinct capital flows arriving at the same domestic asset terminus simultaneously. The verification point is Broadcom's Q3 print. If AI chip revenue reaches or exceeds the $16 billion guidance, and Tan's history of conservative guidance makes that the base case, the growth allocation returns and the commodity rotation loses its second reinforcing flow. Canadian energy's structural supply chain re-rating survives either outcome. The pace and magnitude of the rally does not. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.